One of the things about our show is it's going to be unique.
You are what you do. You can say any amount of things that you want to say, but what you do is what everybody sees.
Some people are like, oh, I'm just going to JV it. Like, let's just JV it. Like, what the hell does that mean?
I cannot tell you how excited I am to hang out with you guys today, so thank you so much.
Well, then that end buyer could come back and say, well, I didn't fully understand that it was subject to.
That's not a thing. Like, the SEC has thought of all of these things. They've been here since 1932.
And you can do what you want with your property.
Buyers have time, they have negotiating power, they have options.
Oh my gosh, I am blown away by your inexperience, and they've been in business 20 years.
And that includes things other people put on your property, right? It's your property that'll be okay. Suddenly, Cousin Jimmy's in a lawsuit.
A novation is replacing one contract or one obligation with another.
Out with the old, in with the new.
Yes.
Hey, good morning, everybody. It is 2025, and welcome to the show. Today, our topic is tax changes for the year 2025. I'm Andy Fowler, and I'm here with Sean St. Clair. If you're new to the show, make sure to like our channel. You can find us on YouTube, Facebook, or X. In each of those platforms, you can find us at the handle at NREM Podcast. I want you to go there, subscribe, and like the show. We would appreciate it. Also, you can download an audio version of the podcast, whether that be Spotify, Apple Podcast, or any other platform. Go to it, download it, leave us a review, subscribe, like, helps us out a ton. With that, we're going to go to Sean, who has our legal update.
Thank you, Andy. My legal update today is discussing the difference between a member-managed and a manager-managed LLC. This is where I see a lot of mistakes made in LLC formations, and in particular by clients who either try to do it themselves, or they maybe hire somebody that doesn't really, maybe a service that claims to know what they're doing with forming these entities, but then the service doesn't really walk them through exactly the difference between these two and let them make a proper selection. And so they end up forming it incorrectly. And then inevitably we're approached to do, say, an operating agreement or to help with a real estate transaction. And when we start working with the client and the client's explaining, exactly what's going on with the LLC, we say, okay, great. And then we go and we look at the LLC and it's formed incorrectly. So basically the issue lies in not understanding that there's really two types of LLCs. We just refer to LLCs as LLCs, but we don't think, oh, there's two types. There's what we call member-managed LLCs and manager-managed LLCs. And so starting first with a member-managed LLC, a member-managed LLC is exactly how it sounds. The members who also own the LLC manage it. So the members own the LLC and they manage it. They're responsible for the day in and day out operations of the LLC. They're responsible for executing documents, for signing to open bank accounts, for hiring professionals. Basically, they're responsible for it all. And pretty much if it's member managed, any member has that authority, although the operating agreement of the LLC can limit that to, say, a set number, a majority in interest, a super majority in interest, two members, whatever the case may be, whatever number you define. You can put that in the operating agreement as to those members having that certain power and authority to act on behalf of the LLC in that way. But the presumption is for a member-managed LLC that the members both own the LLC and fully manage the LLC. Then you have what's called a manager-managed LLC. And this is typically used for the situation in which you want somebody other than the member to manage the LLC. So manager-managed is just how it sounds. You have a manager, a third party that generally doesn't own it, but they could, but an individual or a company who's responsible for managing the LLC, and that is their job. So sometimes you would have multiple members, and the members decide they want just one member to manage, so they would form a manager-managed LLC. And one of the members would be the manager. Other times, and this is more common, is that you would have members who say are LLCs, but they want an individual to manage the affairs of the LLC. So they would do a manager managed LLC and name an individual who's not also a member or an owner to manage the LLC. And as a manager, they pretty much control the day in and day out affairs of the LLC. And there's a lot of decisions they can make. They sign documents on behalf of the LLCs. They open bank accounts. They hire professionals. Basically, they run the LLC. It's like they're the CEO of the LLC, and they're fully in charge of running the LLC. And once again, the operating agreement can give them complete control, or it can limit their control. It can reserve certain duties and obligations and powers to the members. And that's the advantage of having an operating agreement is it can be customized so that you define who fills what role. One last thing I will point out on manager managed LLCs, and this structure is if somebody's done an estate plan and then they also have an LLC, most of the time the trust will be named a member of the LLC. So the trust will be the owner of the LLC, but then they will name the individual trustees of the trust, so the people who created the trust basically, as the actual managers. That way, when documents are signed, it doesn't have to be signed as ABC LLC by, Jane and John Doe Revocable Trust by Jane and John Doe, its trustees. Instead, it can just be signed by ABC LLC by Jane Doe, its manager, for example. And then they can sign it, and you don't have to go through the litany of different setting up a signature block with all this different authority to actually just sign a document on behalf of the LLC. So that's the difference between member managed and manager managed LLCs. A member managed LLC, the members or the owners also manage the LLC. And then in a manager managed LLC, it's going to be managed sometimes by an appointed member, but other times it's going to be managed by third parties who are not members.
All right. Thank you, Sean, for the legal update. All right, let's talk about a few announcements. We have the first Creative Finance Collective of 2025. That is today, every Tuesday afternoon at 3:00 p.m. That's Arizona time, 3:00 p.m. Arizona time. So adjust accordingly if you're in another state. What is the Creative Finance Collective? That is an opportunity, really just a live opportunity of professionals in the space, mainly lawyers, that get together who focus on the topic of creative finance, creative financing, whether it be transactionally or involved with creative finance from a litigation perspective. Sometimes there's a variety of lawyers and what they focus on. But we get together and we talk about what we're seeing in the space, what we're seeing in different states, what we're seeing in our own states with respect to laws, with respect to transactions that have gone well, have not gone well, what was missing, what wasn't missing. But it's an opportunity for you, the listener, to learn about creative finance and to ask us questions. We're there for an hour or so, as long as we're receiving questions. So if you want to engage with us, inquire about what this investment strategy looks like, the risks, the rewards, the pitfalls, what you have to watch out for as you're going through it. We're not the cheerleaders of creative finance. We're those that dissect it and talk about, how this has to be done correctly and the risks that you face as you move forward with it. So if you have an interest in that, make sure to join us live with the Creative Finance Collective. That's on YouTube, Facebook, or X. It's live at 3 p.m. today. Make sure to join us. Also, if you have any questions today about our topic or for our guest, we're going to take any of those questions in the final 15 minutes of the episode. So, and we're monitoring the chat. So as you think of those questions, make sure to post it in the chat. We'll get to those and address any questions that you have. With that, it's a new year. We've got lots of things coming down the pipeline in 2025. As we all know, we have a new presidential administration. We're all watching with bated breath what that's going to mean legislatively across the country. And in some of those areas that affect all of us, no matter what state we're in, is in the area of taxes and taxation. There's been a lot of discussion in the mainstream media about what taxes are going to look like under a new Trump administration. And that's in addition to what taxes or changes to the current tax code are already in place because it's a new year and things that you need to be aware of. So we're talking about tax changes for 2025. And with us to discuss that topic is Chris Scoggin. Chris, thanks so much for joining us. We really appreciate having you.
Oh, my pleasure to be here. Thank you for setting this up.
Yeah, no, we're really looking forward to getting into this with you. Now, Chris, you're a CPA. Why don't you tell our listeners a little bit about yourself, your background, your business, and how you got into doing what you do?
Sure, absolutely. I appreciate the opportunity. CPA, my office is located in a bedroom community of the Phoenix area. By way of background, I've been a CPA in Arizona for 33 years. Got my start in the title industry. I started with Chicago Title, spent 10 years as the chief financial officer of the largest title agency in Arizona. Took that experience and then diverted into high tech around the year 2000. Spent some time in there and then opened up my own firm. Firm's been open since 2004, so we are now in our 21st year. I cannot believe that. We do specialize in real estate transactions, whether that is configuring and reducing, minimizing gain on transactions. We also serve a big part of our practice is serving foreign nationals that are selling real estate in the United States. I'll leave it at that. If you have any questions, we'll give my contact information towards the end of the session.
All right. Really good information. So Chris, what we want to do is kind of break this down in two ways. One, we kind of want to just look at what are some changes that are naturally occurring within the tax code anyway, because it's a new year of 2025, irrespective of the new presidential administration and what we're hearing in the media in terms of proposed legislation. Let's just talk about right now what we should expect to see regardless of all that going into 2025. So first one that comes to mind is standard deductions. Some of these things just change with each given year. Why don't you explain for somebody who might have just, came onto the podcast and learning for the first time, what is a standard deduction? What was it in 2024? And what do we expect to see in 2025?
Sure. We'll start off with, typically when I give numbers out, I'm speaking married filing joint. When I give those numbers, if you have a single filer, cut those numbers exactly in half. And then if it's a head of household, I can discount it by approximately 25%. The standard deduction, and what the standard deduction represents is the amount of income that you can earn without having any income tax liability. The standard deduction for a married couple this year is $29,200. That's for 2024. They have not released the 2025 standard deduction yet. They usually do that in the fourth quarter, so we don't know exactly what it'll be for 2025, but it is adjusted by the cost of living adjustment. So it'll probably be in the $30,000 to $31,000 range next year for that. Of course, we as CPAs are always focused on last year. We are getting ready for the 2024 filing season. $29,200 for married couples. Again, half of that, $14,600 for a single person. And it's $21,900 for a head of household. That is, if you have a dependent, single person with a dependent or more. And then if you're over 65, there is a bonus. You can deduct for each person over 65 in a married household, $1,550 added to that standard deduction. That takes the standard deduction for a married couple, both over 65, to $30,700.
Good. What about, so in talking about the standard deduction, you mentioned income. Income brackets are a big thing that really every citizen's thinking about because they have a job. But, sometimes, when you just receive a W-2 paycheck, you put it on autopilot. You don't really think about it because the system's just taking it out depending on what you did. But a lot of times business owners are like, well, I don't even know what I'm going to make. We'll see how this plays out. And I've got a plan for it going into 2025. So why don't you break down kind of where the income tax brackets sit And maybe like the standard deduction, we don't know what they're going to be for 2025. But why don't you kind of break that down where we're at there?
Sure. So the tax brackets, again, once you get over either the standard deduction, I wanted to add, if you itemize and your itemized deductions exceed the 29,200, then you would itemize. Again, that increases your tax-free income. But the brackets, once you clear the standard deduction, start at 10%. For a married couple, for about the first $20,000 of income, it's at 10, and then it jumps to 12. Ultimately, the top tax bracket, if you're earning over $700,000, is 37%. Anybody can Google the tax bracket, so I won't get into the exact dollar amounts, but there's two numbers that I'd like to impress upon your listeners at this point, and that's the numbers 125,000 and 425,000. Why those two numbers? And again, these are including whatever income would be tax-free. But at 125,000 for a married couple, you jump from 12% to 22%. That is the biggest jump in all of the tax code. If you have a client that you're trying to manage their tax liability and they are at that threshold of 125,000, is there anything you can do to keep their income below that? Or let's say that you have a client that is at 90,000 and you can recognize an additional $30,000 of income selling stocks, maybe a short-term sale of stocks, and get them up to the 120,000 and have them get taxed at the 12%. So again, you want to pay attention to the 125,000, half of that for a single person. The same thing happens at 425,000. And I'm rounding by $1,000 or $2,000 here, but think 425 and 125. At 425,000, you go from 24% to 32%. So those are the two biggest jumps. Just keep those two numbers in mind. If you've got somebody that's just below that, you've got an opportunity to maximize their income up to that 125 level and keep them in the 12% bracket, or alternatively up to the $425,000 level and keep them in the 24% tax bracket.
So Sean and I are one of the areas of practice, though this is a kind of a real estate focused show. We talk a lot about estate planning, and we do some estate planning as attorneys for our clients. So we handle it transactionally, and then we recommend it for real estate investors or any type of investors who's in business to be thinking about that. We love to, in theory, talk about the estate tax exemption because it's something you ought to think about. But the exemption amounts have been high for some time, and they don't impact a lot of folks because of their amounts. Why don't we talk about where is the estate tax exemption at, and are there any changes we're expecting to see into 2025?
Sure, absolutely. And you're absolutely right. For an estate tax exemption for 2024, it's $13,600,000. It jumps to essentially $14 million for 2025. And what that means is that if a person passes away and their estate is less than that, they won't owe any estate tax. If their estate is over that, then they need to be speaking with their attorney and their CPA because they could have an onerous tax liability. Going into 2026, with the Tax Cut and Jobs Act expiring, if you think back to 2017, the year prior to the Tax Cut and Jobs Act, or otherwise known as the Trump tax cut, it was at 5.6 million. We are, and I know that we're going to get into this, we are anticipating that higher exemption limit will be extended. There's no guarantees, though, as we talked just before we went on the air. I've given up trying to set odds on something happening. So that is one item that with my clients, I'm really thinking about and hoping that they will extend the estate tax exemption and keep it at that $14 million level, inflation adjusted. But if that drops back down to 5.6 million in 2026, we've got to do a lot of planning with a lot of our clients that they won't get caught in that trap.
So, Chris, one of the hot things out there in real estate right now is self-directed, whether it's using your 401k, your IRA, but basically being able to go out there to invest, to make loans using your retirement accounts. So are there any changes this year for the amounts that can be contributed to, say, 401k plans?
So that is inflation adjusted. You can contribute up to $23,000 to a 401k plan. If you're 50 or older, there's an additional $7,500 that you can contribute. So $23,000 for 2024. It's $23,500 for 2025, plus the $7,500 for 50 or older. For your self-employed people, you can do a SEP IRA or a simple IRA. Essentially, think of those as a self-employed 401k plan. You can contribute up to $69,000 to a SEP IRA. You've got the $23,000 that you can contribute individually, and then your employer, which is your own company, can contribute up to $46,000 for you. So we can do that. We could get into money purchase plans where you can get up into the multiple hundreds of thousands of dollars of tax-free contributions. But for the most of my clients are self-employed individuals. That $69,000 limit on the SEP IRA is more than enough than they want to put in. But again, to answer your question, $23,000 maximum contribution to a 401k plan for 2024, $23,500 for 2025.
The other thing that's out there, and I will tell you, I didn't really realize it until preparing for this show, that there's income phase out ranges for Roth IRAs.
There is.
So what even is that? And what are we looking at in 2025 as opposed to 2024?
Sure, absolutely. There are income ranges to limit your contributions to a Roth IRA. Those are actually easily circumvented, though. Mm-hmm. You can do what's called a backdoor Roth. So first of all, for a married couple, between $230,000 and $240,000, your ability to contribute directly to a Roth IRA is phased out. For a single person, it's between $146,000 and $161,000. However, you can contribute to a traditional IRA. You are not afforded an income tax deduction for that contribution to a traditional IRA. And then you can, at that instant, you make the contribution. The same day that you make that contribution to a traditional IRA, you can convert that to a Roth IRA with no tax consequences. That's what's known as a backdoor Roth. Virtually every investment advisor that's worth their salt will understand when you say, hey, I've heard that my income is too high to contribute to a Roth. I've heard that I can do a backdoor Roth, and there are no income limits to doing that backdoor Roth. So again, contribute to a traditional IRA, instantly convert that to a Roth IRA, and you're good to go.
All right, good stuff. All right, so it's almost like they don't want us to retire putting these income phase-out rules on Roth IRAs. It's we saw that and we're like, what? Just when we think we're about to get ahead.
Yeah, absolutely. You know, these types of contributions are my favorite way to reduce the tax liability for my self-employed clients. And boy, most of my clients are people that, are not in the millions of dollars of income, but they're in the hundreds of thousands of dollars of income. And we love to use these. I always say the highest level of tax deduction is one where you're investing in an appreciating asset. Your retirement is no greater example of an appreciating asset.
All right. So Chris, you mentioned, and the elephant in the room, of course, is, and that Trump passed a big tax plan during his last administration. It was not permanent, though. And unless you've been living under a rock, everybody knows that those taxes that were passed as part of that plan expire at the end of 2025. So, of course, that's a major legislative goal for the Trump administration on day one to try to get that done. But for those of us professionals who assist people, and then for those individuals who have to, think about their own tax situation from year to year. This is something that really needs to be on every person's radar. Okay, what will happen? Obviously, if a law is passed, we'll deal with that as it comes. But what could theoretically happen? Well, we know what theoretically could happen is that that if nothing's done, the tax law goes away completely. So let's kind of set the table here so we have an understanding about what currently is in place and what it would mean for those taxes to come off the table. Let's first talk about the qualified business income deduction that was part of Trump's tax plan. What is that, and what would it look like for that for this tax plan to expire and that be gone?
Sure, great question. So the QBI, Qualified Business Income Deduction, is part of the 2017 Tax Act that allowed small businesses with income roughly below $330,000 to deduct 20% of their profit as non-taxable. So if you had a small business owner, business had $100,000 in profit, they're only going to pay income tax, I should say, on $80,000 of that. Now, I want to be careful here that depending on the way their business is structured, they would still owe self-employment tax on that income if they are a sole proprietor or if they are a general partner in a partnership. So the 15.3% Social Security Medicare tax would still apply to that income, but they would only pay tax on 80% of their business income for income tax purposes. That is a big one. That is one of the most business friendly tax deductions that came out of the Tax Cut and Jobs Act. So basically what it would mean is for a small business owner, they would have a 20% increase in their effective tax rate on their business income. Again, the QBI does phase out. I'm just checking my notes. I've been in this business long enough that I do need to just double check that. But yeah, so it is at $336,000. The QBI does start to phase out. It phases out over about the next $60,000. So at about the $400,000 of business income, you can no longer take advantage of that. But essentially it's that. If you have a small business, a closely held business, not a C corporation, I want to be careful about that, it would be a partnership, an S corporation, or a sole proprietor, you're only paying income tax on 80% of your income. Don't forget about the Social Security and Medicare. That can be structured around. Talk to your CPA or talk to your attorney if you are paying Social Security and Medicare on over $100,000 of income.
Now, you mentioned a phase out that applies there. Have you heard one way or the other whether proposed changes to the tax law or making these tax laws permanent, that phase out is on the table to increase, what it might be, or get rid of it altogether?
I haven't heard about an increase in the phase out amounts. These phase out amounts are all inflation adjusted. Anytime you have a tax law that will get passed, we're almost assuredly going to have something happen with tax code this coming year. It's tough to project if that would be increased. I have not heard anything. I have scrubbed the internet, and there's a number of proposals that we have out there. I haven't heard anything on either increasing or decreasing or eliminating the QBI deduction. So we think that that's going to stay in place. It's incredibly popular. It is, definitely, as I said, it's probably the most powerful incentive that was put into the Tax Cut and Jobs Act. And so we don't think, hopefully this administration will be business friendly. We do believe it will be. And that's one of the things that almost assuredly would be continued, probably in its current state with its current limitations.
Now part of the Trump tax cuts was lowering or adjusting the tax rates and bracket amounts. And you may not know this, it's been a while ago, but approximately, what did those brackets look like before Trump's tax cuts, and where are they now?
Sure. Roughly, And I'll go through the first few tax brackets, but roughly what happened is there was a 10% cut in the effective rate of taxes. Now, both the pre-Tax Cut and Jobs Act and post-Tax Cut Jobs Act, the first tax bracket was 10%. But prior to the Tax Cut and Jobs Act, the next bracket was 15%. It's now 12%. So it went 15, 12. The next tax bracket was 25. The current bracket's 22. The next tax bracket was 28. The current tax bracket is 24. So you can see it's roughly about a 10% increase across the board, not counting that first 10% tax bracket.
So, well, so the lesson here, I think, as we're seeing with each of these, is if you remove and let 2025, let it expire in 2025 and do nothing, higher taxes across the board. Is that fair to say?
It is, yeah, and frankly, it would be higher taxes across the board. For somebody that's making $60,000, would probably not be that large of an increase if this expired. Just frankly, because if you're at $60,000, you're really only paying tax on $30,000 of income. You would still have that 10% tax bracket. But the other thing would be a reduction in the child tax credit that would go back in other reductions that would be less lower income friendly. Definitely, as we move up, the people that are paying more tax would see their tax bill increase pro rata larger than somebody that's paying less tax. So it would be, for every person, it would be a tax increase, even for somebody that is in the $50,000 or $60,000 range for income.
So I don't want to relive the estate tax discussion, because when we talked about that, you pretty much nailed down, I think, what would be the difference if we lost the current exemption amounts and what it would go down to. But talk to us about a kind of a similar feature to this that we didn't talk about, but the lifetime gift exemption.
Sure.
And those amounts, and what that looks like, and what would it look like for 2025 or for the law to expire in 2025.
Absolutely. So as you know, the gift tax is hand in glove with the estate tax. And that's because, as you well know, and as your listeners well know, back when they originally put the estate tax in place, people said, well, I'll just gift away my assets before I die. And so they put the gift tax in there to capture what you're giving away prior to death, and that reduces your estate tax exemption. The biggest misnomer that I have in my practice, one of the biggest, is people coming in and saying, hey, I gifted $150,000 to my son. What's my tax liability going to be on that? They're surprised to hear zero. You're not going to have any tax liability on that gift tax return, but it does need to be filed, because if you gave $150,000, first of all, the first $18,000, one individual to another individual, is exempt. You don't have to file a gift tax return, nor does that reduce your lifetime estate tax exclusion. But once you exceed that, then you've got to report to the IRS. In this specific example, that'd leave $132,000 that would come off of your currently $14 million lifetime exemption. No tax would be due with that tax return, but it does need to be filed. And again, right now it's $18,000 person to person. If you have a married couple giving to, say, their son and their daughter-in-law, each spouse can give $18,000 to their son and $18,000 to their daughter-in-law. So you can give up to $72,000 without even having to file a tax exemption, married couple to a married couple.
All right. So in addition to the laws that are in place, of course, there's been those proposals that we've heard in the media, and things that appear to be kind of options that they may be considering going forward in whatever tax legislation looks like. Trump had talked about reinstating and making permanent the 100% bonus depreciation.
Yeah.
Why don't you talk a little bit about, what that is and what that would mean?
Sure. So we're talking about both Section 179 and bonus depreciation. The rule when the Tax Cut and Jobs Act was put in to encourage business investment is that if you went out and bought specific assets, Not every asset qualified, but most of them did. Any asset that had a useful life of less than 20 years, with the exception of automobiles, that's a different animal, that you could buy that asset. And it used to be, the tax code said that if you've got an asset that has an economically useful life of greater than 1 year and has a reasonable capitalization amount, normally taken to be about $2,500, depending on your business. I mean, General Motors, Google, $2,500 capitalization limit's not going to apply. But you used to have to capitalize that and depreciate it over its useful life as defined by the tax code, 3, 5, 7 years. The Tax Cut and Jobs Act allowed you to buy an asset and write the entire thing off in the first year. I said automobiles are one of the exemptions, but if you buy a vehicle that weighs more than 6,000 pounds, I know it's a random number, but that's the number, you can depreciate that entire vehicle in the first year. If it's less than 6,000 pounds and more than $15,000, there is a depreciation schedule you still have to pay attention to. But if that goes away right now, so that has dropped off. It was 80% for 2023. It's now 60%. You buy a $100,000 vehicle over 6,000 pounds, you can take $60,000 worth of depreciation in the first year. That vehicle has a 5-year life, so you would break up the other $40,000 over the next 5 years. You would actually get $60,000 bonus depreciation plus $8,000 annual depreciation in the first year, $68,000 first year, $32,000, $8,000 each of the next year. That is scheduled to go away at the end of 2025. The depreciation amount drops to 40% for 2025. It's 60% for 2024. We do anticipate that bonus depreciation, Section 179 depreciation rule, will be pumped back up to 100% if the tax cut goes through, like we think it's going to. We think that will be reestablished at 100%. And again, the thinking behind that is that they are trying to encourage the purchase or replacement of business assets, hopefully to spawn the economy, to get things moving.
So let's break that down, because this is actually probably one of the biggest things or advantages for our real estate investor listeners. So the vehicle, let's talk about vehicle first, and then I want to talk about real estate. But the vehicle, does that need to be purchased in the name of a business in order to claim that depreciation?
It doesn't necessarily need to. If it's purchased by the individual, we would account for that vehicle being contributed to the business. The titling of that vehicle does not necessarily determine specifically ownership. Now, I will tell you, in an audit, and if that vehicle's titled in your name, but it's listed as an asset of the business, then we're probably going to have to explain that to the IRS agent. If you get an IRS agent that's having a bad day, he theoretically could throw that out, but it's not required. I do recommend it. I do recommend, if you have a vehicle that you purchased individually because of finance reasons, a lot of times people can only qualify for financing individually and not in the name of the business. Go down and retitle it at the DMV, take an afternoon and get that thing retitled in the name of business. But again, it's not completely required.
Now let's talk real estate. So if, let's say I have an investment property that I buy in 2024, and presumably they should put it into an LLC.
Yes.
Can any investor or any individual who buys that take that bonus depreciation, or are they limited to having the real estate professional designation?
No. So if they buy real estate, if it's rental real estate, it must be income producing real estate. We're not certainly talking about your own private residence, but a commercial building that you buy for your own business, or a residential rental that you are renting out. You can depreciate that. The IRS has, again, depreciation rules for residential real estate. They depreciate over 27 and a half years. For commercial real estate, it's now 39 years that gets depreciated. But one of the things that we have seen in the increase, oh, by the way, the real estate, that property is not eligible for bonus or Section 179 depreciation. Assets need to have shorter than a 20-year life to qualify for that. But what we have been seeing is an increase in cost segregation studies. And a cost segregation study goes in and looks at the components of that building: HVAC systems, flooring, countertops, cabinets, mechanical components to the building. And these are engineering firms that come in, they do a study, they break that out, they properly price those assets. And then all of a sudden, you've got an air conditioning unit that can be depreciated over 7 years. You have kitchen cabinets that can be depreciated over 5 years. So in that instance, because they are now less than 20-year property, now we can apply bonus depreciation rules. I had a client that bought a commercial property in Phoenix for $420,000. We were able to come up with $160,000 of mechanical and other components. We'll be able to take $160,000 first year depreciation times 60% on that. So we'll get them about $100,000 deduction first year. Caveat, remember, this reduces your basis in the building. So when you go to sell that property, whatever depreciation deduction you have taken over the years, whether that's a huge first year or just taking the 27.5 or 39-year depreciation, that income will come back to you if and when you sell that building at the purchase price or greater. By the way, that income will be recognized as ordinary income, not capital gains income.
Chris, talk to us about the corporate tax rate. Trump proposed reducing that from 21 to 20% and a 15% for companies that manufacture in the U.S.
United States.
Yeah. Break that down for us, and what types of corporations is that going to apply to, or would that apply to?
Sure. Let me take the second half of your question first. So the greatest amount of our business entities are sole proprietors, partnerships, S corporations, and C corporations. Only the C corporation pays income tax. Sole proprietors, partnerships, and S corporations are what's known as pass-through entities. So the owners of those entities are paying income tax on their 1040 personal tax return. If you are a partner in a partnership or you own a member in a LLC taxed as an S corporation, you'll get a K-1 and you report that income. So there's no tax paid at the corporate or business level. C corporations, though, they are taxed at the corporate level. And then to the extent that a C corporation pays out dividends or profits to its shareholders, those dividends are then taxed as ordinary income to the shareholder. So that's what we call dual taxation. You're right. Right now, we have a 21% corporate tax rate. That's still considered on a global level a relatively high tax rate. Most corporations throughout the world are taxed in the 15 to 18% range. So what that would mean, though, if we were able to have a business that was manufacturing or producing its product in the United States and is enjoying a 15% tax rate, you're going to see more businesses switching from a partnership or from an S corporation to a C corporation. There are definitive benefits for being a C corporation minus the double taxation issue. If you have a business that is capital intensive, so you are rolling your profits back into that business, so you're making money in the business, but you're investing as much capital as you're earning, you're reinvesting those profits. It may be worthwhile to now consider becoming a C corporation, paying that 15% tax rate at the corporate level, as opposed, and then keeping your money in the business, not paying out dividends, because you're reinvesting that money into your business assets or the growth of your business, as opposed to being an S corporation, where you recognize the profit, you pay tax on the profit. Again, you might be at the 24 or 32% tax rate on those profits, and then have to reinvest that what is left over back into the business. So it may, if this goes through, we will be talking about, is a C corporation or an S corporation the most tax efficient entity type for your business? Again, that's going to apply to businesses that are reinvesting a tremendous amount of money, that have tremendous amount of capital requirements. So if you are reinvesting in your business and you're not taking a lot of money out of your business, except for maybe W-2 wages, it may be, if this goes through, a benefit to reclassify as a C corporation.
I remember this conversation happening initially when on the first go around, when they passed the first law, this idea that the corporate tax was decreasing, and that raises the possibility of, wow, the C corp might be a beneficial thing. Clearly, it hadn't hit that percentage threshold. It sounds like your thought is, if it hits 15%, boy, it's kind of right on the edge, and a lot of small businesses may be thinking about that, because that makes a lot of sense, right? What incentive do I have to keep pumping my money into the business when I'm going to get taxed on it? Because it's passed through.
Exactly. If you do make that decision, be careful though. There is, an excess capital tax that if the IRS comes through, and this is more art than science, but if you were to get audited, and there's not a lot of audits going on like we think of an audit, but if you were to get audited, one of the things they're going to look at, if you've got a tremendous amount of capital built up in a C corporation, the IRS could come through and say, hey, you've got excess capital in here. You need to distribute that capital out to the shareholders and have them pay dividends tax on that. So that it's not without pitfalls, but you're absolutely right. A 15% C corporation tax rate versus maybe a 24% individual tax rate when you're contributing money back into the business to grow that business, it may be beneficial to be a C corporation.
So one area that I think would impact our real estate investor clients is the ability to basically deduct state and local taxes that they pay. And I think right now there's a cap of $10,000.
Correct, $10,000.
So what constitutes state and local taxes?
Sure, absolutely. So first of all, state and local taxes are going to be income tax, or this is an or sales tax. You can either deduct the amount of income tax you pay to the state in a year, or you can deduct sales tax. Now, I don't know anybody that is keeping every receipt. The IRS does have a formula that we can use to estimate, based upon your income, to estimate your sales tax. So when we look at the state and local tax deduction, and this is part of the itemized deductions, going back to the start of our conversation, the standard deduction of $29,200, we are comparing that standard deduction with your itemized deductions. Right now, up to $10,000 of your itemized deductions can come from state and local taxes. And again, the first component of that is either your income tax paid to the state or your sales tax paid. If you buy a vehicle, you're going to pay a tremendous amount of sales tax. Make sure that your CPA or your tax accountant gets a copy of that invoice if you buy a vehicle. The next component of it is real estate taxes, property taxes. You can deduct property taxes on your primary residence. You can also deduct property taxes on non-income producing properties that you are holding for investment purposes, a second home. You can also deduct property taxes on things like an RV or a boat, as long as they have a kitchen, a bathroom, and a bedroom. They can be considered a second property, a second home, and you can deduct those. You can also deduct any personal property tax that you pay. Most commonly, these would be your automobile registration fees. So again, state income tax or sales tax, real property tax, and personal property tax are the deductions that make up the state and local income tax limit up to $10,000. You're right, they are considering, this has been one of the least popular provisions of the Tax Cut and Jobs Act. Anybody that lives in Illinois or California or New York or some of these higher property tax, we're in Arizona, luckily, If you're watching outside of Arizona, we're a relatively low property tax state. But for these higher property tax states, this has been incredibly unpopular. These are people that are paying $20,000 and $30,000 in real property taxes, and they have not been able to take advantage of that deduction. So we are thinking that it'll go to $50,000 if the new tax act is passed, but to be seen.
So my understanding, though, is there's a little bit of a way around this for a small business owner to increase that deduction, which is through the prepayment of estimated state tax on business profit or corporate profit. So what would that look like?
So you can make an election where the partnership, typically it's the partnership or the S corporation, is going to pay the tax for the shareholders. And you're absolutely right that does become the state portion of that. So if the partnership pays the tax for the state, for the shareholders, that tax becomes a deduction for the partnership. So all of a sudden you've moved the deduction that you may not be able to take advantage of on your itemized deductions. You've moved that deduction over to the business, and now the business can take that deduction on behalf of the partners or the members of that entity. So you're absolutely right. Now you have reduced your business income by the amount of the state income tax that you would owe. That is a method that we use to get around the state and local tax limits.
Now, would that apply? Let's say you just have, some real estate investors. They own, let's say, 10 rental properties. Can they basically take advantage of that? Maybe it's taxed as a partnership, not an S corp or anything like that. Can they utilize that to pay some estimated state taxes? Okay.
Yeah. So if it is set up as a partnership, they can pay those taxes out of the partnership, their state taxes, and again, take them as a business deduction as opposed to an individual itemized deduction.
And then they would still get their individual $10,000 itemized deduction.
That's correct. Yep.
Okay.
So then they would be able to, if they've got real estate taxes on their home or on their RV or on their vehicles, or if they have up to $10,000 of state tax liability that gets paid in, they would still be able to take up to the full $10,000 on their itemized deductions, as well as have the state tax associated with their partnership or with their business, even if that's rental real estate inside of an LLC, be able to take advantage of that deduction at the partnership level.
But it must be taxed at a partnership. So like a sole proprietorship wouldn't work.
That's correct. Yep.
So one of the dirty words in Washington is, or to suggest any change would be a dirty word, is usually when we're talking about Social Security. But Trump's proposed a change to the taxation of Social Security benefits, which is to say to not tax them at all. What are Social Security benefits currently taxed at? What would this mean?
Sure. So let me talk married filing joint, because the numbers are different than single. But for married filing joint, and we talk about an income stack here. So we're adding up all of your income from all sources here. If all of your income from all sources, not counting Social Security, is $25,000, I'm sorry, let me check my notes here. I'm sorry, $32,000 or less. $25,000 is the single amount. $32,000 or less, your Social Security will be taxed at 0%. In other words, no dollars from Social Security will come over into the taxable column. And then for a married couple, from $32,000 of other income, not counting Social Security, to $44,000 of other income, the amount of Social Security that you will be taxed on is 50% of what you receive. So if you got paid out $20,000 from Social Security and your income was $35,000, your taxable income would now be $10,000 from Social Security. So $25,000 plus another, $35,000 plus another 10, $45,000 of total taxable income. Once you exceed the $44,000 threshold, of other income, not counting Social Security, then Social Security is taxed at 85 cents on the dollar. I want to be clear here. You're not paying an 85% tax rate. It's just that 85 cents of every dollar that you receive comes over into the taxable column. And then we apply the tax rate, whether that's 10% or 12% or 22%. So again, if your income is $32,000 or less for a married couple, zero tax on Social Security. If it's between 32,000 and 44,000, 50% of your Social Security will get taxed. If your income's over 44,000, 85% of your Social Security will be taxed. So this is really a situation that if we eliminate tax on Social Security, you're only going to get taxed on your other income. This would affect a tremendous amount of people. It's very rare, at least in my practice. I do have a number of retired people, but it's very rare in my practice that I see anybody enjoying the 0% Social Security tax rate. So it would allow them to get their Social Security minus any taxes.
So finally, talk to us about, and we've been hearing this in the news for months now, the no tax on tips. Break down for us. I think we all have kind of a general concept of what tips are, but not probably from a CPA's perspective. What is that, and what would it really mean?
This is one where, oh boy, you talk about clients getting creative. I've got clients that are saying, hey, if this goes through, I'm going to charge $1 for my service and then just request tips. Well, I can assure you that the IRS will be well ahead of this. So tips have traditionally been earned by people that are in a service industry. This will be limited. The IRS will be looking at this. So if all of a sudden you have a plumber or an attorney that is reporting tip income, the IRS is going to be very, very curious about how is an attorney earning tip income, or a CPA, or anybody. So I first thing I want to dispel is I have a number of my clients that almost jokingly have called up and say, how can I convert my income to tip income? Well, tip income has traditionally always been separately reported for W-2 wage earners. I'm going to suggest, and I don't know for a fact, but I suspect that this will only be available to wage earners, and it will only be available to the amount of tips that are reported on your W-2. Those tips would have to have some basis in reality. In other words, can we go back to the credit card receipts for the tables that you've waited to see and track what your tip income? But it's exactly that people that are earning an hourly wage, their hourly wage would be subject to income tax to the extent that they are earning legitimate tips. That tip income would be tax-free. Now, most of that's going to get reported on a W-2. I doubt that either of you have been waiting tables in the last 10 years. But if you had, you'd realize, and I get to see numbers of W-2s, they report the tips separately. And that tip income is obviously being managed by the business, the restaurant, or whatever entity where the people work. So I think there's going to be two caveats. You must receive W-2 wages. Your tips must be reported separately, and they're going to need to be reported by your employer. So anybody that is self-employed is thinking about how can I rearrange my business model to only be paid in tips, or to have the majority of my income come in tips. The IRS is going to be about 3 steps ahead of you, and that is going to be a giant red flag that would be waved if you were to go forward with that.
All right. We're taking down the tip jar at the front desk, Sean.
There you go.
No. Chris, we really appreciate you taking the time to go through this. This has been really, really great information. Tell our listeners how they can find and connect with you.
Sure. Again, we are located in a bedroom community outside of Phoenix area. It's in Maricopa. My phone number is 520-568-3303. You can go to our website at CSCPA Group, all one word, cscpagroup.com. And then my email address is C Scoggin, first initial last name. So it's C and then my last name of SCOGGIN at cscpagroup.com. Happy to reach out, give us a call, shoot us an email, or jump on our website and you can get a hold of us there. We're always happy to just sit down, and I always tell my clients and potential clients, always happy to get on the phone, take 10 or 15 minutes. Let's take a look at your situation. Is there something that we can do for you? Do you need a second opinion? Always happy to offer that. And there is no fee for that, no fee for the initial consultation.
Yeah, and for those watching on the YouTube video, we'll put Chris's information in the description so that you can find him there. Chris, again, awesome information. Let's do this again sometime.
Absolutely. I appreciate the opportunity.
All right. Thanks so much. We'll see you next time. With that, everybody, that is our show. Make sure to join us for the collective this afternoon, and we'll see you next week.
Have a good day, everyone.